in an ET Now special. We're trying to decode the ways to make wealth through coffee can investment strategy. Listen into a conversation where the authors of the book Coffee Can Investments share ways to invest and how to indulge in wealth creation. Here they are in conversation with Nikunj Dalmia.
What is the definition of great companies and how should one differentiate between good businesses and bad businesses? Well, to discuss all that and much more, I have with me the author of the book, and the book is in my hand, Saurabh Mukherjee. There you go, Coffee Can Investing. Saurabh, Mr. Chauhan needs no introduction, and Samit is one of the finest mid-cap fund managers I've ever come across. So gentlemen, thank you for joining us and welcome to the show. Saurabh, must compliment you on your book. It was very insightful. I enjoyed reading it, and I really got a new dimension to the way how one should look at investing. Believe in the power of compounding and always be patient. But in your book, you are comparing your coffee can portfolio with the Sensex, and your study is indicating that coffee can portfolio has consistently managed to outperform the benchmark, especially Sensex. Why is that?
So look, I think what we have tried to do with the coffee can is we've relied on something called smart beta. So especially in the West, smart beta strategies have become the straightforward way, the low-cost way to outperform the market. So the ETF is the market. The ETF and tracker funds obviously have been spectacularly successful in the West. Tracker funds are catching on in India. But if you want to outperform the tracker fund, what is the straightforward way to do it? And smart beta has been seen as the way to do it. Now, there are many types of sources of smart beta. There are many ways to do smart beta. I said to my colleagues 4 years ago, let's keep it very simple. Let's identify Indian companies who are growing at a steady rate, 10% per annum growth, who are profitable, 15% ROC, and let's invest in companies who over a 10-year period are consistently able to give 10% revenue growth alongside 15% ROC. Now, as luck would have it, there is only 15 to 17 such companies in India. But the remarkable thing is whether you built a coffee can 10 years ago, 3 years ago, you built it today, over a 10-year run, you get 10x in 10 years broadly. So you get around 23 to 26%, which is a good 7-8 percentage points better than the market. So both in back tests of the coffee can and in the live money that we manage for clients, we're getting outperformance to the market of 6, 7, 8 percentage points per annum. And we're getting volatility, which is 30-40% less than the Sensex or the Nifty's volatility. So tracker funds are a valid way to go about investing in the market. We've endorsed tracker funds very enthusiastically in the book. But what we are saying is if you want to outperform tracker funds, a straightforward way to do it is have a simple rule like this. My rule is 10% revenue growth and 15% ROC. Buy a bunch of good stocks and then just let it be for 10 years. Don't mess around with your portfolio.